Hello, and welcome to this episode of First Service Residential's Board Brief, our series of short, informative videos you can watch on demand whenever you want and from wherever you like. My name is Anthony Gregnano. I'm a Vice President in First Service Residential's High-Rise Division, and it's my pleasure to host today's discussion about managing your association budget and finances as a follow-up to our board certification course. Today's conversation represents perspectives from our panel of experts. As always, consult your professional partners, association attorney, CPA, or others to determine the best course of action for your community. Ensuring your association's financial health is crucial to maintaining property values and enhancing residents' lifestyles in your community. And it is one of the most significant responsibilities of the board of directors. By covering your financial basis with a well-crafted budget and sound financial planning, your board can address maintenance needs, implement capital improvements, and develop engaging programming for your residents. So how do you get started? What steps should you take to create a healthy budget that ensures the financial well-being of your association now and in the future? Joining me today are An Wen, Vice President at First Service Residential.
Hey, Anthony, how you doing?
Glad to have you today. As well as Susie Pesos, Property Manager at First Service Residential.
It's a pleasure. Thank you.
So Susie, let's kick it off with you. I think it's important to start with the basics. What are the fiduciary responsibilities and obligations of condo and HOA board members?
Well, that's a great question because as a board member, there are certain responsibilities that you need to act upon. For example, all board members should be well informed. They need to gather as much information and act in a good, positive way for the association, especially when they have to make very critical decisions. One of the key things that we have with the state of Florida are Florida statutes, and these statutes help us guide what the board members need to do. For example, condominiums have 718 statute and HOAs have the 720, which helps them outline exactly the direction that they need to go. So the most important thing is to make sure that you're working in the best way for your association and to make sure that your neighbors and your community is working properly.
No, those are all great points, right? It's so critical as we move through. So let's move on to budgets. Can you walk us through how an association budget, what should it include? What are some of the budget components that shouldn't be ignored? Let's start there.
Thanks, Anthony, and board members, thank you for joining us and thank you for your service to your communities. So your association's budget is the financial plan that outlines the projected revenues and expenses for the upcoming year. And the first thing you want to do, as Susie mentioned, is to review your association's governing documents because that will outline any specific responsibilities for preparing, implementing, and funding the annual budget for your community. Now, there are two portions to the budget, the revenue side and the expense side, right? And so on the revenue side, the dues or assessments are the primary source of income for most associations. A payment schedule for those dues or assessments must be determined, whether monthly or quarterly or semi-annually or annually. And oftentimes that schedule is predetermined in your governing documents. Also, depending on your community's amenities and services and the way it's built, you may have additional revenue sources such as rental income. If you have a restaurant, food and beverage income, event fees, if you have a lifestyle focused community, architectural modification fees, fines for rules violations, access device sales. These are all other sources of revenue that can supplement your budget. And remember, the association is a not-for-profit corporation. So in the proposed budget, your total revenue cannot exceed your total expenses for the year. Now, on the expense side, your budget should cover all daily operational expenses like administrative costs, maintenance costs, vendor contracts, insurance, and utilities. And additionally, depending on the association, you may need to set aside funding for reserve accounts to cover future capital expenditures and deferred maintenance. So let's talk really quickly about reserves. So for condominiums under Florida Statute 718, you are required to set aside reserve funds for building painting, roof replacement, pavement resurfacing, and any other item that has a deferred maintenance or replacement cost that exceeds $10,000. That is the bare minimum of what condos are required to set aside for reserve funds. For HOAs under Florida Statute 720, there are no mandatory reserve accounts required to be funded in your budget per statute. However, you are required to fund reserves that are initially established by the developer. Additionally, the membership can vote to establish statutory reserves, which are mandatory. And even board members can establish what is called non-statutory reserves, but that is limited by your governing documents. So take a look at your governing documents or consult with your attorney for more info. But that's basically a breakdown of what a budget entails, Anthony.
No, that's all great info, right? And just a little side note just on the reserves, obviously, with the new law changes and several of the items in regards to Sears and all of that. So definitely work with your reserve study analysis and vendors to be able to ensure that you have all those right items. But also, when we talk about income, I always laugh because unfortunately, all the assessments come from the homeowner. So all those ancillary incomes that you start to look at, just use caution. I always say use a little bit of caution about how much other income you put in, because it's sometimes not always guaranteed, right? Late fees,
Sure.
other items, fining or others. And then Susie, I just wanted to touch base with you because I know in some of your communities, you have some very unique things that might be specific to communities like beach service or something. That how do you make sure you're capturing those items for the lifestyle side?
Well, as you mentioned, Anthony, and you are correct. It is important to know what the lifestyle that your community has. So for example, there are communities where 24-hour valet parking is considered mandatory versus a optional item. Beach service is another thing that if you're right on the ocean and you have the beach service, or you have a sauna, or some of these additional amenities that not all communities have. But it is important to understand what your community is like and make sure that you are looking to handle what is needed and consult the professionals that are going to guide you to make sure you're doing the right thing.
No, absolutely. All great insight, right? As you know, we've seen a humongous, a great increase in large for the insurance costs on the rise, and salaries and wages have been skyrocketing with inflation and others. Are the communities you're working with having to raise their dues to offset these costs? How are they handling it? And if so, is there a limit to how much dues can be raised?
Great question. And the answer is yes, unfortunately. I don't know about you, Anthony, Susie, but up here in Northeast Florida, we've seen dues increase up to 40 or 50% in some communities over the past 2 years. It's been incredible. And the question we often get is, can a board do that? Can they increase their dues that much? So the first answer is always consult your attorney, check your governing documents. There may be specific language that limits how much the board can increase their assessments year to year. But for condo associations, Florida Statute 718 states that if assessments exceed 115% of assessments from the preceding year, then a substitute budget can be requested by the owners. To do this, 10% of the owners must petition the board in writing within 21 days after budget adoption. Now, here's the catch. To determine whether assessments exceed 115% of assessments for the prior year, you have to exclude reserve funding. So the stipulation can only apply to assessments for operational expenses, not reserve funding. Now, for HOAs, there is no state law imposing limits on how much an HOA can raise dues each year. But again, check your governing documents.
And with all that, right, these, we know that that's in the statutes and some of the limitations or rights that homeowners have. But again, you have to have insurance. You have to have utilities. You have to have staffing in some form or fashion, right? So there is always a balance there when it comes to these challenges of these rising costs. So with that, Susie, can you share some best practices on how you handle homeowner dues increases and deal with that communication and obviously getting the community to understand the why?
Well, it is critical that educating your community, your membership is critical. The board, the more they communicate, the more clarity there is around what's in your budget? What does it really take to run your association? How do you successfully balance that, the increases with the needs of the owners to try to make sure that they're able to pay their dues? So it is important that you look at what is the goal. Just keeping a flat budget is not really the prudent thing to do, because there are costs that have happened within, as you mentioned, Anthony, insurance and all, but there's also the cost of living, where gas alone or things like this have increased. Everyone has to buy food, and they've had to buy certain things, that those goods have increased. So with the associations in our communities, we're finding that that is something that gets increased. Not only do you have a contract, let's say, with your landscaper, but now your landscaper has additional fuel cost, or they have additional staffing, and the cost to pay that landscaper becomes a little bit more. So that contract becomes an addition. So be realistic. Let's make sure you're getting everyone to realize that it is something that it's not what you want to do, it's what is needed to really run the community and your association as the best that you can.
No, absolutely. All great tips, and holding your vendors accountable during this time is important as well, right? Making sure that whatever your contracts are, that they're delivering to the full contract requirement. So let's say we've gone through the budget process, we've done all the right things, we've gone through contracts, we've gone through utilities, we've gone through what we thought repairs and maintenance are going to be, we've thought about what special projects we want to do. It's mid-year on, right? And operating budget's running, according to what we planned, but now we have a major event that might have occurred, or a project that needs to happen. What options are there for when there are these other expenses or reserve expenses that might over exceed what we planned on?
Well, there are two options. You can readopt a new budget with a higher fee if you want to do that, new operating budget, but you can also use the S word, which is special assessment. And yes, most board members do not want to do that and see that happen. But for many associations in this day and age, it's a reality, a stark reality. If you don't collect enough money to fund your daily operational expenses, or you don't have enough reserve funds set aside for a capital expenditure that you have to do at a given time, then the association can levy special assessments on the owners. You'll need to refer to the Florida statutes and governing documents for guidance, and of course consult your attorney, but that is definitely a reality and an option for boards.
Absolutely. Never easy, right, Susie? I know you've been through a few, and it's always a challenge, but definitely as board members, you have that fiduciary responsibility to ensure that we are operating and funding. And then of course, there are always options for loans, right? And I know a lot of associations right now are looking at potential loan options for especially those larger capital projects as well. So again, back to your governing documents. So now we've collected money, or we've assessed the homeowners, and we've done all this, right? We're now in the process. What happens if homeowners aren't paying, or there's a delinquency? And obviously the association depends on all this money to afford the operations. What steps, Susie, can an association take to manage delinquencies effectively?
Well, the key to managing delinquencies, it starts at the beginning, which is setting clear guidelines as to what is the expectation. When is the money due? When does it become late? How quickly can the homeowner send the payment? What is the expectation? Also, are there going to be late fees? Are there going to be interest collected? What are the penalties for failing to do this? So if you have a clear-cut policy that explains when it's due, you then enforce it correctly. It is important that you always make sure that you're doing consistently. There's nothing worse than when, well, this guy's a nice guy. I understand he's having some financial issues, but this other guy is always a pain, and maybe we will go ahead and take repercussions there. It is critical that as board, you're doing the right thing and making sure. Also look for different things that are available, such things as technology is out there now, where there is ways of collecting money. So owners can set up a auto debit, so you're guaranteed cash flow from the beginning of the month. because as it's a trickle effect. If you're not collecting the money, then you cannot pay for services, and then your services are going to hurt. And it's a whole domino thing. So by collecting and doing the proper explanation to the owners from the moment they buy in, you have these dues, they're due, this is when it's due, this is what's gonna happen if you don't pay. And then, of course, the communication. How far do you need to go to collect the monies? The easier you make for owners to be able to pay, to be able to get those auto debits and things that are one and done, make it easier for you to not have to be chasing. You're always going to have a situation where you need to remedy, and then if you're not collecting, then that's where the next steps go in to the enforcement side. Our attorney's gonna have to get involved. Are you going to need to levy and go further into the ramifications that the statutes give you and your governing documents give you the ability to, how do you collect? But the biggest thing is, the easier you make it, the cash flow, it's easier for you.
Yep.
And also the well-being of your association.
No, I think you definitely hit on two very important items, right? Consistency and automation, right? So that whatever your 30, 60, 90-day policy is, it's automatically going to the attorney. It's automatically going through the process. Because once you start to move off of that, all of a sudden you blink and it's now 8 months that someone's delinquent because, oh, they didn't get sent to the attorney, or we thought they were going to pay next month. And you're well back, further back in the line where you should be. One thing I'm not sure I heard was also restriction on amenities, right?
Oh, that's true. Yeah.
Statute
You have those remedies where if someone is not paying, you could restrict on the amenities. You could also ensure that certain things get done correctly within your community. So they would need to restrict. You would need to also take away their abilities to vote and some of the other remedies that are given to you by the Florida statutes there.
No, absolutely. All great things. So now we've talked about budgets, we've talked about special assessments, we've talked about how we now collect. Now it's year end, right? And how do we make sure everything worked the way it was supposed to? So I know that there's a few items for financial reporting that are required for associations.
Yeah, Anthony, every year at the beginning of the year around this time, associations are required to provide an annual financial report to their membership. And this is usually done by an independent CPA. And the level of financial reporting is always based on the annual revenue for the association. So for Florida statute for both condos and HOAs states that there are pretty much 4 levels, right? The first level is a report of cash receipts and expenditures, and that's required for associations with an annual revenue of less than $150,000 or associations that operate fewer than 50 units, regardless of the annual revenue. The second level is what's called a compilation, compiled financial statements. And that's required for associations with annual revenue between $150,000 and $300,000. And then the third level is a reviewed financial statements, which are required for associations with annual revenue between $300,000 and $500,000. And then the last and highest level of financial reporting required for associations with 500,000 or more annual revenue is the audited financial statements. So again, your financial reporting type is usually outlined in your community bylaws or based on your revenue here, but those are the requirements, and every year you should be engaging with your CPA to provide that statement.
Absolutely. And again, I think most of the associations, at least in many of our worlds these days, are definitely going to be at that audited financial statement. Just with all the increased rising costs alone, many associations hit that. So I want to thank An and Susie for today. We've covered a substantial amount of information and appreciate you taking the time to speak with us. And to our viewers, thank you for joining us on this segment of the Board Brief. Keep an eye out for future episodes designed to support the great work you do for your condos and HOAs. We'll see you again soon.